morning. Oh, good afternoon. How are you? Good afternoon, Angelica.
Good afternoon, Miss.
How are you?
I'm fine, Miss. How are you?
I'm fine, thank you. Just give me a few minutes. I'm just waiting for the other students to join. And we are going to start our session then, okay?
Okay, no problem, Miss.
Thank you so much. We have one student who is attending physical class. I'm just waiting for the others. Harshit, how are you? Fine. Did you get any chance to revise the lecture? Yesterday's one? Oh, that's great. I have forwarded the soft copies of the books. So you have downloaded them already. That's great. And I just suggest you that you should save all of the PPTs in one other folder. Okay? Just make the different folders for different subjects and just make sure that you have all the material with you. Angelica, I want to know one thing. Are you able to see the whiteboard properly? If I do some calculations on the board, will you be able to see them properly? Angelica, are you there?
Yes, Miss, I'm here. It's not that clear, but I think I can. Yeah, I think I can see.
Okay, let me just move the camera a little bit near to the board. Now, what do you say?
Yeah, it's much better now.
Let me just write something. Is it visible?
Yes, Miss.
What have I written?
1, 2, 3.
Okay, that's right then. Because I am not able to see it properly from here. So because from today, we are going to start a little bit of calculations. So it's necessary that you should be able to see it. Okay, anyhow, I will be helping you also. Just give me a few more minutes and then we are going to start. students, I think we should start our lecture. Actually, I was waiting for the other students to join, but we have only one student who has joined physically, and we do have one student who has joined us online. So welcome both of you to my class. Today, we are going to start with financial management. The older name for financial management used to be F9. F9. Now we do call it as FM. FM stands for financial management. This is the last subject from the skills module. And after that, you will be moving towards the professional module, inshallah. And FM is going to be having its elaborated subject in optional papers also. We will be facing AFM in optional papers. In options, as we do know that there are 4 papers. From 4 papers, we are going to select any 2 papers. And financial management is going to be the one out of them. So it's your choice. If you ask about myself, I had selected not financial management for my specialization because I selected performance management for my finalization. So it purely depends upon you. Anyhow, financial management is must to pass if you want to move towards Oxford Brookes University degree as well. If you do want to get Oxford Brookes University BSc in applied accounting, then it's most that you first have to pass first 9 papers of ACCA. So these first 9 papers of ACCA do have their individual significance. So my dear students, without wasting any time, we are going to start our lecture number 1. As you can see on your screens, that the first thing which I'm going to tell you, it's about the paper pattern of our exam. My purpose is to make you people understand the concepts of the financial management deeply, so that not only after passing the exam, you must be able to apply the concept right now at the moment, but in the future as well, when you will be when you will be becoming the working professionals. So my dear students, as you can see on your screens, that our total paper will be distributed into 3 parts. We will be facing short questions. We will be facing objective type cases, and we will be facing comprehensive response questions also. The paper pattern is almost the same as you are going to face for taxation, like we have discussed yesterday. And the only difference among the paper pattern of taxation and financial management is in this last portion. Comprehensive response questions can be different for taxation and financial management. The number of comprehensive response questions can be different for taxation and financial management. So let's start from the first part of the exam. In the first part of the exam, you will be facing 15 short questions carrying 2 marks each. Short questions can be multiple choice questions. They can be true, false. They can be drag down list. They can be a drop down list. But fill in the blanks would not be there. If there would be a fill in the blanks, then the options to fill in the blanks would be given. Blindly, you will not be required to write anything. One more thing which I would like to tell you people over here is that financial management exam, again like taxation, will be held on the computer. All of the paper must have to be attempted on the computer. Word document and spreadsheets are going to be faced by you, and on both of them, you will be required to solve your answers. As far as the second part of the paper is concerned, it will be having 3 objective type cases. Some scenarios are going to be given to you, and from those scenarios, you will be required to attempt the answers. So 3 objective type cases will be given to you. Each of the cases will be carrying 10 marks each. So the total of the second part will be 30 marks. As far as third part of the paper is concerned, it will be carrying comprehensive response questions. 2 comprehensive response questions are going to be asked, carrying 20 marks each. My dear students, you must know that in taxation exam, Either 3 comprehensive response questions can be asked or 2 comprehensive response questions can be asked. But as far as financial management paper is concerned, it's must that you will be facing only 2 comprehensive response questions. All of the paper must have to be attempted necessarily. It's compulsory to attempt all the questions. There will be no choice. Before to some time, ACCA used to give choices in the exam questions, but now it is gone. So you will not be having any kind of choices in your exam. So your third part of the exam will be carrying total of 40 marks. 2 CR cases will be presented to you. You have to attempt both of these, and both of these will be carrying 20 marks each. So I hope that you are cleared about the paper pattern. The total time available to attempt the exam will be 3 hours, same like the paper of taxation. If you do have any questions, you are most welcome to ask me. Yes, Hashir, any question? No? What about you, Angelica?
No, miss, everything's fine.
Okay. So now, my dear students, first of all, we are going to start with the basics of financial management. Again, I would like to tell you the thing that your total paper will be based upon theoretical as well as numerical questions. You should not be misconceiving that the numerical paper will be consisting of only numerical questions. ACCA has a policy to make the papers containing 50% theory portion at least and 50% of numericals, because they do want you to analyze the situations. Your work doesn't end only after solving the numericals, but you will be required always to analyze the situation. And this happens when comprehensive response questions are going to be asked. Even in the multiple choice questions, you will be faced equally as per the equal weightage of theory and numerical questions. So our first topic for today, the financial management function, is basically the first chapter from your book of Kaplan. We are going to follow Kaplan publishing for our financial management as well, and we are going to study chapter-wise. So our first topic for today is the financial management function. This will be telling us about the basics of the financial management, and this is the first chapter of your Kaplan Publishing ACCA-FM book. Students, you must know that what is a financial management. Financial management is about the management of finance. Finance is very important for any kind of a business. Whatever business is, whatever organization is formed for the purpose of earning profit, finance is of utmost importance. We cannot neglect the importance of finance for any business. It has the same value as the blood does have in our body. Without blood, our body cannot work. Without finance, the businesses cannot be run. So in this subject, we are going to learn that how the organizations will be managing the finance. This is our subject. We do know that there are other subjects related to finance, like financial accounting and management accounting. But financial management is not the same as financial accounting or the management accounting. We can say, or we can relate financial management to the management accounting somehow, but still there is a difference in the time scale for which the operations are run in the management accounting and the financial management. But financial management is very much least related to the financial accounting, because in the financial accounting, we are just concerned about recording, classifying, and summarizing the business transactions. But here in financial management, we have to manage the total finance for an organization. We will learn that how the organizations deploy short and long-term finance into the different operations, into the different activities, so that the shareholders' wealth can be increased. Because now you are the student of financial management, it's important for you to know that businesses do have an objective to increase shareholders' wealth. Before to this subject, your teachers might have told you always that a purpose of business is to earn profit. But here, I would like to elaborate this view that a purpose of business is to increase shareholders' wealth. Increasing shareholders' wealth does not always mean to increase profit. So now you have to elaborate your view about making profit. It's not just to make profit, but the purpose of running a business is to increase shareholders' wealth. So how the organizations do manage the finance in order to increase the shareholders' wealth, this is our subject matter. And this is what we are going to learn in this whole subject. Over here, on this first slide, they are giving you the definition of financial management function. What is a financial management? So Hashir, they say that financial management is concerned with the efficient acquisition and deployment of both short-term and long-term financial resources to ensure that the objectives of the enterprise are achieved. You must understand this definition very clearly. They say that financial management is concerned with the efficient acquisition and deployment of both short and long-term financial resources. Why? What is the purpose for doing that? To ensure that the objectives of the enterprise are achieved. My dear students, over here, efficient acquisition of resources means that the organizations are going to compare different sources of finance with each other so that they can ensure that the sources of finance, the finance is acquired in an efficient manner. Then, after collecting the finance, their duty is not going to stop. If someone is a financial controller or if someone is a financial manager, they have to ensure that they are acquiring suitable source of finance, and then they need to ensure that this finance is now deployed or invested in the suitable sources, because organizations do care about this finance a lot. Finance is very important. Without finance, the organizations cannot grow. The organizations cannot do anything without this finance. So financial management is concerned with the efficient acquisition of resources. The managers are going to choose from the different sources of finance, and then they are going to deploy both short and long-term financial resources. Why? Why are they going to do all of this work? Because they do want the enterprise to achieve its objectives. And what is the objective of an enterprise? Increase in shareholders' wealth. So I hope that you are clear that why are we here to study this subject and what is going to be the subject matter of this whole area. Are you cleared?
Yes, Miss.
Great. Have a look at the slide once again. If there is any point about which you are not clear, please let me know. Yes, sure, please. Okay, now, Moving towards the next slide. Here we are going to learn about the nature and purpose of the financial management. This is again the elaboration of the definition which has been provided in the first slide. If you can see over here, they are telling you that financial managers are going to make the decisions in 3 key areas regarding investment, regarding finance, regarding dividends. Financial managers or financial controllers in their whole working tenure will be taking the decisions about these 3 important areas. Number 1, investment. Both long-term investments in non-current assets and short-term investment in the working capital. Finance. Which sources of finance have to be used in order to deploy the finance in long-term operations and short-term operations? As we do know that investment is going to be made in the long-term operations as well as in the short-term operations. Short-term operations are going to include working capitals. What is a working capital? It's a capital, yes, dear. It's a capital which will be used in order to carry on day-to-day activities of a business, in order to purchase inventory, in order to pay salaries, wages, etc. So financial controllers will be looking that in which portions, in which operations do they need to make investments. So they will be taking the investment decisions. They will be looking that from which sources the finance has to be raised. There are going to be the multiple sources of finance in front of the organization, and the financial controllers have to decide that which source of finance is the most suitable one. They also have to decide about the dividends. Dividend is a return which is given to the shareholders because they are trusting the entity and giving the funds to the entity so that the operations can be carried on. You should keep in your mind that dividends are not mandatory to be paid. Even if the organization is running well, and even if the organization is earning profits, even then it is not mandatory for the directors of the organization to pay the dividends. Anyhow, financial controllers of the organizations will be taking the decisions about the dividends, that whether the dividends have to be paid to the shareholders of the organization. If the dividends have to be paid, how much ratio of the total profit will be given as the dividends to the shareholders, and how much is going to be retained within an organization so that future investments can be made. So these 3 areas are interlinked to each other, and our total syllabus of financial management revolves around these 3 areas. We will be learning about the investment decisions made by the financial controllers. We will be learning about the finance decisions made by the financial controllers. And last but not the least, the dividend decisions made by the financial controllers of the organization. So your slide says that decisions must be taken in 3 key areas: investment, both long-term investment in non-current assets and short-term investments in working capital. Decisions must be taken in 3 key areas, and the second key area is finance. From what sources should funds be raised? And the third key area is about dividends. How should cash funds be allocated to shareholders, and how will the value of the business be affected by this? We do have one more student in the class. My dear, welcome to the class. May I please know your name? Atif. Atif, welcome to the class. And you are a little bit late. Okay. Okay, so every week on Thursday, our class will be from 3 to 6. I just request you to be on time. Otherwise, you will be losing some important data. Okay. So we have just started our lecture. I had waited for 12 to 13 minutes for the students to join, and then I've started my lecture. So you can just continue from here, and there are first 2 slides left. We are going to discuss them later. Towards the end of the lecture, I will be discussing them with you. So anyhow, I was telling students that the purpose of the financial controller to be in the organization is to manage these 3 key areas. And our total syllabus of the financial management revolves around these 3 key areas. They will be deciding that investments have to be made in which areas so that the shareholders' wealth can be increased. They will be deciding that if finance has to be raised, which sources of finance shall be used. They are going to decide that whether the dividends are going to be given to the shareholders or not. If yes, then how much ratio of the total profit must be given to the shareholders as dividends, and how much must be retained within an organization so that future investments can be made. So it's important for you people to know that your total syllabus of financial management will be revolving around these 3 areas. If you are clear about this slide, I would like to move on to the next one. Okay. So my dear students, this is a very important slide. If you will be cleared about this one, trust me, you are cleared about 5% of the financial management course. Please make sure that you understand this slide very much carefully. Students, if I do ask you people that, do you know about the accounting equation? Yes. Do you remember the accounting equation? Every one of us has passed F3, Financial Accounting Exam of ACCA. So every one of us does know about accounting equation as well. What is an accounting equation? Angelica, what is it?
Assets is equals to liability plus equity.
Assets is equal to liabilities plus equity. Am I right?
Yes.
We all know about this accounting equation, but how many of us does know the detail of this accounting equation? Do you know that in statement of financial position, we do base our financial position on this accounting equation? That is why we do call our SOFP, statement of financial position, as a balance sheet also. Because we tend to tell people that assets are always equal to the liabilities and equity in a business. What is a liability?
It can be the current borrowings.
Current obligations or the long-term obligations. These can be current liabilities or the non-current liabilities. Or we can say that liabilities are the right of third parties on the business. Am I right? The right of third parties on the business is a liability. Whatever obligations the business is having towards the third parties rather than the shareholders is known as a liability. And on the other hand, we can say that equity is the right of shareholders on the business. Am I right? Up till now, maybe you people do know that equity is a share capital which is invested by the owners in a business. But equity is far more than that. It contains share capital, it contains share premium, it contains reserves, it contains retained earnings. Whatever surplus the business is having after fulfilling all of its obligations and liabilities is the right of the equity shareholders. So the right of shareholders in the business is equity, and the right of third parties rather than the shareholders in the business is liability. And what are assets? These are resources. These are all the economic resources. These are all the things which the business is using in order to earn profit, in order to increase shareholders' wealth. And from where the business is getting all these resources? From the shareholders or from the third parties. It means that the total finance which is coming to the organization so that shareholders' wealth can be increased is coming either from the third parties or from the shareholders. So this is the background of accounting equation. And this leads us to the concepts of the financial management. It tells us that the two important and major sources of the finance for any company are debt and equity financing. Either the business is getting the finance from the third parties or it is getting the finance from its shareholders so that assets and resources can be got in the business so that the business operations can be run and ultimately shareholders' wealth can be increased. And I would like to tell you people once again, do not confuse shareholders' wealth with just increase in profit. Shareholders' wealth is far more than just a mere increase in a profit. I hope that you people are clear about this in it. Please make sure that you are clear about it because it will be making the basis for financial management. Okay, now when I say that the financial controllers had the first duty to make the decisions about the finance. So this is what I meant to say. That they are going to see that from which sources they are going to receive the finance. Are they interested to get the finance from the third parties? Or are they interested to get the finance from shareholders? Both of these sources of finance do have their individual characteristics. Organizations cannot totally depend on any one of these. They cannot get all of the finance through debt financing, or they cannot wholly and solely depend upon the equity financing. Because in both the cases, the organizations will have to see a lot of matters. And according to those, the organizations are going to take any further step. Anyhow, the finance raised, it will be invested in the company. How it is going to be invested? Either it will be used in the day-to-day working of the company as a working capital. Say, for example, you have to pay any of your suppliers, any of your creditors. You have to meet the need of the short-term loan. If you have taken a short-term loan, you have to pay the cost of servicing that debt. Or you are going to invest it in the long-term investments. You are going to purchase the non-current assets, furniture, fixtures, equipments, etc. So you are going to invest them in the non-current assets, or the dividend is going to be paid to the shareholders. And organizations do not do a mistake of paying out all the dividend to the shareholders. It's purely upon the wish of the directors whether the dividend is going to be paid to the shareholders or not, because they have to decide for the future of the company. If all of the dividend, if all of the money is going to be paid as a dividend, then organizations will be running out of finance and future investments cannot be made. And the organization is going to suffer. So my dear students, the three important decisions under the jurisdiction of financial controller are financing decisions, investment decisions, and dividend decisions. And you will be sitting on the seat of a financial controller. You must remember that three decisions are now required by you. You have to take the decisions regarding financing, regarding investment, and regarding dividend. You have to take the decisions that from which sources the finance is going to be acquired and in which opportunities that finance has to be deployed so that shareholders' wealth can be increased. So I hope that you are clear about this.
Yes.
If you are clear, we can move forward. And my dear students, if you feel any confusion, you are most welcome to ask me. So Atif and Hashir, both of you should not be confused at all.
No.
Financial management is one of the easiest paper which anyone can pass in one go. I have seen so many students maybe failing in performance management or maybe in audit as well, but I have never seen a student failing F9. financial management. It's very easy to pass. Got it? So Angelika, can we move on to the next slide?
Yes, miss.
Okay. Okay, so over here they are elaborating the concept of the duties of the financial manager. So as I have told you already, that the financial manager will be taking the decisions regarding financing, investment, and dividend. So regarding financing, what are they going to decide? Which sources of finance have to be used in order to raise the finance, either debt financing or the equity financing? What is the total cost of capital which is going to be levied? My dear students, over here, when we use the term capital, the students think that we are talking about equity financing. Please do not mix capital with equity financing. Capital can be either from debt or from equity, both. Got it? Capital is the total investment which is made in a business, either coming from the third parties or from the equity shareholders. So the managers are going to think that if sources of finance, whichever sources of finance are going to be used, how much total cost of capital the organization is going to be. Because whichever source of finance will be used, there will be a cost of using that finance. And it depends upon the risk. Anyhow, the capital structure is going to be decided by the financial managers, that how much proportion of the debt financing must be used and how much proportion of the equity financing must be used so that the organization can run in a balanced manner. And last but not the least, and a very important thing, risk. How the sources of finance are going to be decided on the basis of risk and return. You have known from your previous study, higher the risk is, the higher the return is going to be. The equity financiers every time take the highest risk when they are investing in a business. Return is not promised to them. Am I right? Whenever the shareholders to purchase a share from any company, the return, the dividend is not promised to them. The return is not promised to them. Then why do they get agree to, what we can say, invest in the company? Why will they be interested? Because the return, when they are going to get, will be higher than the other capitals. The debt financing, when some person gives the debt to the company, the returns are promised. The principal amount which is going to be paid is must to be returned back. On the other hand, the interest, that is cost of servicing a debt, is also mandatory to be paid. But still, the debt providers will be getting lesser amount of return as compared to the equity financiers. Equity financiers do have an attraction for investing in the company. And what is that attraction? They know that after fulfilling all the liabilities, whatever is left over in the company is the right of shareholders. Am I right, students? How? Assets minus liabilities is equal to equity. Can you write it like this?
Yes.
What does that mean? After fulfilling all the liabilities, whatever is remaining in the business is going to belong to the equity shareholders. And this is the major attraction for the equity shareholders to invest in the business. We do know that for equity investors, the risk is high, but the return is also high. For debt financing, if the risk is lesser, the return is also lesser. But see from the perspective of the company now. What about the company? When the equity investors are investing in the company, is company taking a higher risk or a lesser risk? Lesser risk. Very good. And on the other hand, when the company is having the debt financing, it is taking a higher risk. Because for debt financing, mandatory repayments are involved. For equity financing, no compulsory repayments are involved. So for a company, it is important to decide the proper capital structure, because if the debt financing is going to be increased, gearing of the company is going to be increased. And the company will be facing problems in the future. Company can become insolvent because of these debt repayments. On the other hand, if the company is going to have a lot of equity financiers, the companies are going to pay dividend and all of the surplus will be returned to the shareholders of the company. So anyhow, the financial managers are going to take the decisions in this area. And this one is a key area of your book as well. First key area of your book is this, second one is this, and third one is this. So the second area in which the financial managers have to take the decisions is regarding the investment. Obviously, when the finance is raised, it is raised so that investments can be made either in the long term or for the short term purposes. So organizational financial managers are going to decide after appraising different investments that where it has to be deployed. Investment appraisal is a very important part, and you will be facing one question at least from investment appraisal. I have never seen a financial management paper, whichever course it is, whichever program it is, without investment appraisal. So there are so many investments in front of financial managers, A, B, C, D, E, F.
Hi, Ms. Muniza.
Yes, Mr. South.
Hi, sorry to disrupt you. Could
Yes,
you
Ms.
please
Parul
take-
is there. Okay, sorry.
Yeah, Ms.
Yes,
Parul is
Mr.
in the
South.
waiting. Ms. Parul
Is
is in
there
the waiting
anything
room,
else?
please. Thank you.
Okay, you're welcome. Sorry. Okay. Yes, Ms. Parul. Do you want to say anything? Okay, anyhow. So if a financial manager has so many investments under consideration, say A, B, C, and they have to consider that which investment should they be carrying on. They are going to appraise each and every individual investment. Monitoring the investment is known as appraising it. They are going to appraise the investments in detail so that they can decide in a better way that in which investment should they deploy their funds. And this is again a key area of our syllabus. Financial managers are going to decide about the working capital management as well. That if they have to invest their funds which are raised from different sources of finance, either they are going to invest in the working capital or in the long-term investments. Again, the organizations do know that if they are going to invest in the long-term investments, their money is going to be holded on for a long term. On the other hand, if all the money is going to be used in the working capital, then the returns will be lesser. So there, the long-term profits can be coinciding with the short term. So this is a concept where we tell people that the organizations should not be compromising their long-term on the short-termism. Next thing, again, is the risk. That how much risk organizational financial managers and organizations are going to face regarding different investments. How much risk they are going to be facing in different kinds of investment. And the last area of the syllabus is dividend decision. Whether all of the dividend has to be paid to the shareholders. If it is going to be the case, then organization is going to be left over with nothing. It will not be having any funds for the future. Or on the other hand, if the organization is going to retain all the money within the premises, organization is going to be vacant, shareholders are not going to be satisfied, organization's market value will become lesser. Because when the shareholders start selling their shares in the market, the normal thing which comes to the mind of the people is that there is something wrong going on in the company. So organizations have to make sure that their shareholders are satisfied. And on the other hand, they do know very well that they are not being given the dividends because it has to be invested in the future. So regarding dividend, the financial managers have to take decisions. So we are going to discuss about the business valuation and efficient markets in this area. So I hope that you are clear about this. If there is any question, you can ask. My dear students, you must know that each of the area is going to be discussed in detail. Okay, with the passage of time, every area is going to be discussed in very much detail. So this is just an overview. And please know your name, Ijaz. Ijaz, Atif. Atif, you should be knowing that total financial management paper will be mix of theory and numerical, as you may have faced in the previous papers of the ACC also. So at least 50% weightage will be for theory and 50% from the numerical portion. Yes. And as far as the paper pattern is concerned, you were not here in the class when I discussed that. When the other students are going to go, then I will be discussing that with you. Okay, just remind me. So can we move on to the next slide?
Yes, Miss.
Thank you so much. Okay, now, here in this slide, we are going to compare the three important fields: financial accounting, management accounting, and financial management. Because students often confuse these three fields with each other. They think that these three fields are the same. They are not the same. We can make a detailed link in between financial management and management accounting, but as far as financial accounting is concerned, it is least concerned with the other two things. As far as financial management is concerned, we do know now that the purpose of financial management is to make the decisions in three important areas regarding investment, finance, and dividend. Whenever we do talk about management accounting, its purpose is to provide the information to the management accountants so that they can plan, decide, and control about the organization. And whenever we do talk about the financial accounting, its purpose is to record, classify, and summarize the business transactions so that the users of the financial statements can know that what is going on within a business. So where financial accounting is just about the recording things, management accounting is about the deployment of the finances in the short-term resources. And financial management is about the deployment of the resources in long-term operations. So here is a key difference between management accounting and financial management. Financial management is going to have a wider view of the operations. If you have seen the organizational structures, you might have seen that on the top there is a financial controller, and below to that there are management accountants and financial accountants also. Why? Because financial controller is a key to finance. He or she is going to see that whether the funds are raised from the appropriate sources and they are going to be deployed in the long-term processes and operations. Management accountants are going to see that on the daily basis, whether the finance is used in an appropriate way to increase ultimately the shareholders' wealth. And financial accountants are going to record all the things. Financial accountants are not going to record the management accounts. The management accounts will be under the area of MA and FM, whereas financial accountants are only going to be in the area of making financial statements. And before to that, the audit trail will also be made by the financial accountants. So from invoices to financial statements and then its audit is the area of financial accounting, whereas raising the finance and its deployment in the long-term and short-term finances is the area of financial management and management accounting.
One question.
Yes, sure.
Can budgeting, forecasting, and future analysis be part of financial management?
Both. Normally, it is a part of management accounting. It is a part of the management accounting. But when they do work as a team, then both of them will be working on budgeting, variances, and forecasting. And ultimately, this budgeting has to be compared with the financial statements as well. So ultimately, three of them are going to be working in the same department, but their areas are going to be different. Got it? So towards the end, normally management accountants do compare the financial statements with each other. So calculate variances. And when variances do come, they are going to be analyzed by the financial controllers. so that future actions, whether in the long term or in the short run, can be taken. Got it? So what your book says about financial management, they say financial management is concerned with the long-term raising of finance. My dear students, when your book says clearly that it is about long-term raising of finance, students do get confused that when short-term decisions are going to be taken, financial managers will be out. It's not like that. They are going to have a proper input in the day-to-day running as well. But as for the wider view, their basic duty is to see that whether the funds are deployed in the long-term sources in an efficient and effective manner or not. Then your book says, and the allocation and control of the resources. Resources means assets. It involves targets or objectives that are generally long-term by nature. So when we do talk about targets or objectives, targets are going to be met over here as well. Targets and objectives have to be met over here. Because this is a characteristic of the organization that every person and group of persons will be working in their own separate jurisdictions, but will be moving towards the collective goal. And then your book says about management accounting, that management accounting usually operates within 12 months horizon. It's not mandatory that management accountants will always be having a look at the areas which are going to expire within 12 months. They will be forward-looking also, but their main area of concern, when we have to distinguish these two branches, then we say that their area of concern will be within 12 months or short term, but however, when this field is going to be compared with this one, then this is long-term in nature. And over here, management accountants is concerned with providing information from more day-to-day functions of control and decision-making. So they are now referring to the management accounts. The management accounts are also prepared under the management accounting so that they can help the managers to plan, decide, and control the matters of the organization. As far as financial accounting is concerned, they say financial accounting is not directly involved in the day-to-day planning, control, and decision-making. Not directly controlled, but indirectly it is also controlled. Because when the financial managers and management accountants are going to take the decisions for the future, they will be referring to the financial statements also as a source of information. So rather it is concerned with providing information about the historical results. So where management accounts and financial management is concerned with the historical and forward results, financial accounting is merely concerned with the historical results. They are forward-looking. They will be looking into the long-term or the short-term operations. Financial accounting, because it is concerned mainly with recording, that is why it will be looking to the historical results. So I just request you to read this slide once again. If there is any point which is confusing you, you can ask. Once you are done, you can just tell me. Angelica, I hope you are fine.
Yes, Miss, I'm done reading.
Okay, that's done. Okay. Now over here, they are again giving you a comparison between these three fields with the practical example. Say, for example, there is a review of overtime spending because it is short-term in nature. Review of overtime spending is done on the day-to-day basis. It's a task which is done as a routine matter. On the daily basis, it is going to come around, and on the daily basis, we have to deal with it. So that is why it is the area of management accounting, because it is not involving any recording phase or classification or summarizing phase of records. That is why we are going to consider it under the head of management accounting. As far as depreciation of non-current assets is concerned, you are already aware of depreciation. What is a depreciation?
Depreciation basically job, you can say, or estimate of useful life of the asset.
Very good. That's how a professional person talks. Otherwise, I was thinking that the definition is going to come that wear and tear in the value of asset is a depreciation. So it means that you have a strong base. You do know that depreciation is an allocated amount over the useful life of an asset. Okay. Anyhow, depreciation of non-current asset, because this is a non-cash expense, it is not going to have anything under management accounting and financial management. It is in financial accounting. Establishing dividend policy. Dividend is a long-term thing or a short-term thing? Long-term. Yes. So it is going to be under financial management. Then evaluating proposed expansion plans. Definitely long-term. So financial management. Apportioning overheads to cost units. This is what you have dealt with in management accounting as well. So this is an area of management accounting. And last, identifying accruals and prepayments. This is financial accounting. So you can consider that whatever is non-cash or whatever is related to the recording is related to the financial accounting. So we can move on to the next slide. Now, here is our next topic. It is about the relationship of objectives in an organization and the management and the financial management. What is the link of overall mission, strategies, objectives with the financial management of the organization? This is what we are going to study here. Now, whenever an organization is formed, first and the foremost thing which is going to be done is to make a mission. What is a mission statement, or what is a mission of an organization? A mission is a long-term objective of an organization. Where ultimately we want to go is our mission. Mission can never be wholly and solely going to be defined in financial terms. It is going to be a mix of financial and non-financial outcomes. It can be about having a greater market share, or it can be to satisfy customers around. It can be to increase the shareholders' wealth, or it can be to grab the attention of the major stakeholders. So mission is the overall and long-term objective of any organization. And the mission statement is the brief statement which defines the overall mission of an organization. It is normally lesser than a one-page length, and every organization does have a mission statement. And I give you an assignment. When you go back to your home, just try to search the mission statements of different organizations. Even CUCA is an organization, and it does have its own mission. Whatever organization is, even if it is a commercial one or a non-commercial one, it will be having a mission with it. Then a mission is going to be divided into some goals, broad-based goals. Some broader goals or objectives are going to be defined out of the mission, because mission is just a statement. It's a brief statement which tells us or gives us a vague idea about the overall mission of an organization, about the overall wider objective of the organization. This mission cannot be communicated to all the persons of the organization and tell them that this is what we require to achieve. They do need some specific goals to achieve. When we make an organization, we divide it into different departments. And to every department or to every division or to every function or operation, we give different targets, because in their own jurisdictions, they are going to achieve targets. And ultimately, the overall mission of the organization is going to be achieved. Then over here, the story doesn't end. After broad-based goals, we do define them into detailed objectives or targets. To give the details is every time compulsory within an organization. because every person cannot understand everything. As per their knowledge, skills, expertise, and understanding, we have to tell them that what are they required to achieve. Every person is not a specialist in every field. That is how we make the departments in the organization so that we pool the specializations in different departments. So different departments are being made, and to those departments, detailed objectives and targets are going to be given. What are we required to achieve is an objective. And how that objective has to be achieved? It's a strategy. At this stage, these objectives are not going to be going alone. The strategies, the ways to achieve those targets are going to be explained. What are we required to achieve? How are we going to achieve? Both of these are equally important. These targets will be commercial or financial. Now, some students can say that what is the difference among these? Commercial and financial, both are money and money related terms. Students, commercial over here is related to the market, whereas financial is just in the finance terms. So you can just make a comparison that if something financial is related to the market also, it is commercial. If it is just a financial, it is not having a long-term impact or a wider impact, it is financial. So the organizational financial controllers are going to consider that which are commercial objectives, which are financial ones, which are going to have an impact or going to take an impact from the market, which are going to be defined and will be implemented only within an organization. Then commercial can be expanding into the new markets. It's a long-term and a market-related issue. So that is why it's a corporate objective. Corporate, longer term. Business, medium term. Operational, short term. Got it? Expansion into new markets is purely a wider objective. It's a long term. It's related to the market. That is why it's commercial. On the other hand, acquire and equip new premises. This is a medium-term decision, medium-term objective related to the market, because acquiring of the premises obviously and definitely is related to the market. It's a medium-term decision. It is a business level decision. Operational level will be on the daily basis, and over here maintain liquidity levels. What is about maintaining liquidity levels? Having enough cash to run the operation. So in order to maintain liquidity levels, it is an operational issue. On the other hand, under financial, if we see return on capital employed, ROCE, how much return is what we can say earned? How much return is earned on the total capital employed within an organization? What is the capital employed? Again, sources of finance. How much debt and equity finance is injected in the business to get a return? How much dollar of money is we are getting in return from each and every penny invested in a business? That is return on capital employed. How much return we are getting out of the capital invested in the organization. This is within an organization. It has no relationship with the market. EPS, earning per share price. This is again the bookish thing. Got it? Project returns. If we are investing something in any investment opportunity or in any project, how much returns we are earning out of that? And last, cash levels, receivable days. How much cash we do have within an organization to run the activities. And receivable days, in how many days we are able to take the money back from the receivables. Got it? You know, receivables days are also going to be managed in an efficient manner so that liquidity in the business is going to be maintained. If the receivable days are going to be enlarged, then receivables will be satisfied, sales will be growing, but no cash will be there in the organization. On the other hand, if receivable days are going to be lesser, sales revenue will be lesser, cash inflow will be lesser in the organization. So we are going to discuss it in detail in the working capital management. So my dear students, if you are clear, we will be moving on to the next. Okay. Here is now a practical example about the objectives. The following list contains some commercial objectives, targets, some financial objectives or targets, and some strategies, all at different levels of the business, corporate level, business level, and operational level. Identify which is which. Corporate level, commercial objective, corporate level, financial objective, or corporate level strategy. Same you have to do with each and every level. So number one is implement. Implement whenever comes. It is normally a strategy. Got it? Implement, we are doing something practically. How to do? Strategy. Implement a just-in-time JIT inventory system. What is it? Strategy. Okay, clear. Which level strategy? Corporate level? Is it a long-term?
No, it's business.
Very good. Very nice. It's an operational level strategy. Just in time, we are going to take an inventory only when it is needed so that the holding costs can be decreased. So because this is a day-to-day decision, it is a strategy and it is going to be taken at the operational level. The second one, increase earning per share by 5% on the prior year. First, tell me, is it a long-term decision or a short-term? Short-term, increasing earning per share
Long term.
by 5% on the prior year. Long-term. Did you tell long-term before also? Yes, it's a long-term. Very good, Angelica, you too. So earning per share has to be increased by 5% on the prior year. It's long-term, so it has to be in the corporate level. Which one it is? Commercial? Is it related to the market? Very good, excellent. It is related to the books of accounts within an organization. It is a financial objective. So this one has to be, okay, let me just write also. First one is here. Second one is here. Okay, the third one, acquire a rival. Acquiring a rival. What do you think?
Premises, so of course, it's a commercial, right?
It's a commercial?
A rival, right? So for share purchase.
Okay, okay. Acquire a rival in a share for share purchase. What is it?
Corporate level.
Okay, last for level or
Corporate level?
no, it's business level, right?
Very good. It is a business level.
For this, I think.
Okay, it's a business level, it's decided. Is it a commercial one, financial one, or the, okay. Who said corporate level? Who said corporate?
Famous.
Angelica? Even I feel it's a corporate level. What about you, Atif? Acquire a rival. Isn't it a long-term decision? Isn't it a wider decision to be taken by the top management? Okay, think like this. These decisions are going to be taken by the persons who are sitting in the strategic apex. These will be taken by strategic business units, divisions of the businesses, and these will be taken by the functions. So this one seems to be corporate.
It will be a strategy.
It would be a strategy. Very good. Why? It's acquisition. Acquire a rival in a share for share purchase.
So how is that?
Because it's acquisition.
Wearing some. So it will
How?
okay.
How are we going to achieve our objectives?
Okay, fine.
We are achieving our objectives by acquiring a rival for a share purchase. Got it? The next one, fourth one. Buy 4 new cutting machines for 250,000 each.
It's operational, operational,
Buy.
Purchase, right?
Okay, first tell me, is it a strategy or what?
No, it's not strategy.
It's not a strategy?
Purchase, right? Purchase.
It's something just planning to increase our production.
Okay, so
And, I feel for corporate objective targets.
corporate
No,
objective,
sorry, operational targets.
operational target. Okay, can you elaborate why do you think that it's operational level target and
Since we
it's a commercial target or financial target? Because it cannot be an operational level strategy then. So if you think that it's operational level target, then which one is it? Commercial or financial?
Financial.
Financial? Why?
When we increase the sales, the production machine is required to increase the revenue,
Okay,
and the revenues are based on some period of time. For example,
okay. Okay. Buying 4 new cutting machines for 250,000. Who is going to make a decision for buying? Are the operational level persons?
Corporate level will take decision.
Corporate level?
Or business. It's our
SPUs.
The limit is there, right?
Yes. No, whatever limit is there, it has to be taken by the strategic business units, SPUs. Because when we are distributing something into 3 levels, it means that we are now speaking about big concerns, multinational concerns, which are having divisions. Got it? So it's now decided that it has to be business level. Because we are buying, we are taking an action. We are making sure that how are we going to achieve objectives? That is why it's a strategy. Buy 4 new cutting machines for 250,000 each. And we are taking this action to make sure that our ultimate objective is going to be achieved. Cleared? Angelica, are you cleared?
Yes, Miss. So, Miss, if it's about buying or like acquiring, it's always a strategy.
Don't try to memorize this, but normally it is so. It is so.
Okay.
When we are putting something in action, how are we trying to achieve our targets? It is a strategy. Shall we move on to the next one? 5th, achieve returns of 15% on new manufacturing investment. New manufacturing investment. We are tending to achieve returns of 15% on new manufacturing investment.
Corporate level, right?
Corporate level. Why do you think like this? Because this one has been the corporate level with percentage. That is why.
No, not that way. Returns.
Okay, sorry.
business level.
Excellent. Business level and financial. Very good. Try to think in 2 areas: commercial, financial strategies, and then corporate, business, operational. Wider, medium level, short term. Short termism, long termism, and medium term. Day to day, within a year, more than a year. Try to think in this way. Commercial, is it to capture a market or something to increase a market share? Financial, sources of finances are going to be used, and within a business sometimes, or apart from the business also, but bookish something. Strategy, way to achieve something, implementing something, putting something in action. Got it? So Atif is very right. Achieving returns of 15% on new manufacturing investment is going to be a financial business level target. Got it? Look, Hashim, when we have had a look on the second one, increase earning per share by 5% on the prior year. How many years are involved? More than a year is involved. And if you see both of these statements, it looks that it's something long-term in nature. It is something medium-term in nature. Got it? Okay. Now, sorry, the fifth one. This one was fifth statement, am I right? Okay, now the sixth one. Improve the ratio of current assets to current liabilities from 1.75 to 1.85. It's a liquidity issue. Am I right? We are trying to improve the ratio of current assets to current liabilities from 1.7 to 1.85. We are trying to decrease our liabilities. Sorry?
Commercial.
Very good. Operational level, financial.
How is it, ma'am? Now you told, but yeah, it's financial, sorry.
It's financial.
Yeah.
We have seen this in the previous slide as well.
Yeah, the business.
It's financial within a business. Okay. So many things are not going to be clear to you over here, but when you are going to read the book, maybe towards the end of the semester, these things will be starting to be clear to you. Got it? Okay. Then number 7, reduce unsold inventory items by 12%. Hashir, is this a corporate level activity?
Unsold inventory item, but what you see. No,
Operation.
how is it? Oh, wait.
Okay, I think so that it is corporate level. Is it?
Wait, yeah, unsold inventory, yes, at the end of the year, it's unsold, so next, how the, yeah, it's corporate level.
No, it's not corporate. How is it corporate?
No, you can be-
Very good. I think that you are working somewhere already and you have a lot of experience also.
That's
It
what
seems.
it's
Reduce unsold inventory. It's a very short-term decision in nature. It is going to be taken on the day-to-day basis. Reduce unsold inventory items by 12%. Sorry?
Should be, the view should be databases, it shouldn't be like yearly basis.
No.
That's the thing.
Medium term, you can consider 1 year. 1 year to 5 year. Day to day,
This is
within
fine.
a year.
I agree with that, like, usually it's said like, at the end of the year, the unsold inventory.
If it's a small concern, if it is a small shoe trader, then maybe. Because in that particular case, the business entities are normally sole traderships or partnerships. They are not LLCs. So when we are talking about big concerns, then this has to be applied. Okay. So very nice, Atif. Reduce unsold inventory items by 12%. It is an operational level activity and commercial one. Okay, 8th one. Update manufacturing capacity to incorporate new technology.
Business level.
Very good. Business level. Business level, commercial one. And the last one we can put over here, but you need to consider that improve brand awareness within the UK. The most highest one. Okay, so it is the corporate level. So improve brand awareness within the UK. It is the top level commercial object. Okay, now have a look at the slide once again. Think that whether you are getting clear about it or not. If you want to discuss something, you can. Students, normally we do take 15 to 20 minutes break in between, but it's as per your choice. If you do not want to take a break, it's fine.
But there is no play room.
Yes, There should be. You have to ask
There is a prayer.
because even I am new here.
There is a
This
prayer.
is just my fourth day. Okay, so I'm not just aware of the rules. Do you want to go and pray?
Yes.
Yeah.
Okay, right now. Okay, so we can have 15 minutes break. Okay, after 15 minutes, you have to return. Okay,
That's usually a race.
because I have to finish my slides today. I will not be going before that.
How about this study material?
I will be forwarding it to you. I do have the email IDs for all of you. Did you receive the Zoom link through the email ID, registered email ID also? I have sent it yesterday. Okay, when you are going to check it, you are going to find that from college side, we are forwarding each and everything on your official email IDs. And moreover, we are going to make a WhatsApp group for the class as well. So over there also, I'm going to send it, but on informal basis. Formally, I'm going to send it through that registered email. So in Jidika, we are going to have 15 minutes break.
Okay, Miss.
Okay. We can start. Okay, now we can move on to the next slide. It is about financial objectives. My dear students, you must know that organizations are formed in order to increase shareholders' wealth. As I was telling you in the start also, that whenever we do tell the definition of business to the students for the first time, we do say that business is any organization which is formed in order to increase profit. But here you must be elaborating your view and you must be getting some wider perspective. Business is anything which is formed in order to increase shareholders' wealth. Because over here we are to get the broader view. We are normally talking about the multinational organizations. So organizations' basic objective is to increase the shareholders' wealth. Organizations may have some short-term objectives like profit maximization or increasing the market share or some social responsibilities or to grow. They can all be the objectives or targets of the organization. But when you are going to study financial management, you must know that financial controllers will always be performing the duties so that the shareholders' wealth can be maximized. Some students can confuse the profit with shareholders' wealth. Students, profit is what we can say, not a wider view. It is a narrow view, whereas increasing shareholders' wealth is a wider view. Profit is always calculated on the accrual basis, having some non-cash items in it. Also, having some items which are not held in the current year or in the forward year, or the historical results are going to be included. When we do talk about the shareholders' wealth maximization, it will always be having a wider perspective. It is about the payout to the shareholders, whether it is in the form of dividends or it is in the form of surplus, which is an excess of assets to the liabilities. Profit is not the same. We cannot pay the dividends out of the profits. Shareholders' wealth maximization means that we want to increase the returns for the shareholders, whereas profit is a non-cash item. But it can also be an objective of the businesses. Businesses can have one objective or more than one objective. So on the priority, this objective is going to be based. Below to that, different other objectives can be downsized. Businesses can have an objective of increasing market share. To increase the market shares means that to increase the market presence, say for example, by expansion, through organic growth, or just by purchasing already built up businesses. So organizations can have an objective to increase the market share so that they can grow their business and they can increase their presence to the wider variety of the customers. Organizations can have a mere objective of growing their share price. And the growth in the share price will obviously ultimately be bringing the shareholders' wealth maximization. But again, share price growth is just a short-term thing. We have to increase the perspective to the broader view. Increasing the share price will be again bringing us to the short-term. The last one, social responsibilities. Organizations have to fulfill an objective of increasing shareholders' wealth, but they do have an objective sometimes or every time to fulfill the social responsibilities also. Some people can say that if this is the only objective of a business to achieve, then why do we focus on the other objectives? Students, these are going to be going hand in hand, not in an isolated way. Why? In isolation, the short-term objectives can be achieved, but long-term objectives can never be met. If, say, for example, the business is not investing on social responsibilities, not giving the insurance to the employees, not giving them benefits, not thinking about the community, not bringing up any kind of advantages for general community like charity or any kind of donations or anything like that, not by fulfilling social responsibility, the short-term profits can be increased. But in the longer term, when these stakeholders are not going to be satisfied, shareholders' wealth is never going to be increased.
Social responsibility will include the taxes also.
No. Social responsibilities are going to be including those things which are related to the persons. Taxation is the legal responsibility, the organization or economic responsibility. The organizations have to pay tax and it is the legal responsibility, it's a statutory requirement. Social responsibility is related to the persons. How are we investing to deal with the persons around ourselves? These can be our employees, these can be our community at a large, or our suppliers, creditors, anyone. So say, for example, on the other hand, the organizations are not investing in the training of the individuals. In short term, the profit is going to be increased. But in the long term, because the people are not learned, they do not have enough skills and expertise, in the long term, the organization is going to suffer and ultimately shareholders' wealth is not going to be increased. So all these objectives go hand in hand, but for the commercial organizations, it's must that the organizations will be run in order to increase the shareholders' wealth. If you are going to consider only profit, it means that you are confining your perspective only on the narrow thing. Wider perspective is to increase the shareholders' wealth. Now, my dear students, nowadays, when so many organizations are in place, we do have a focus on stakeholders. We do tend to satisfy so many stakeholders around ourselves. And why is that? Because the organizations do want to increase the shareholders' wealth. Is it coinciding term? Satisfying the stakeholders on one side, and on the other side, we are telling that the shareholders' wealth has to be increased. Stakeholders include all those persons and group of persons who have any kind of interest in the organization, or persons, a group of persons who are having any kind of risk attached to the business. Stakeholders can be shareholders of the business. Stakeholders can be employees of the business, managers of the business, customers, suppliers, government, tax authorities, banks, etc. Each and every person or a group of persons having any kind of interest in the business is known as a stakeholder. Nowadays, organizations do say that we are not in this world to satisfy shareholders only. We do not have a sole objective to increase shareholders' wealth, but we have to satisfy all of the stakeholders. Then on one side, we say that the sole objective of the organization is to increase shareholders' wealth. And then we say that we have an objective to satisfy or balance the needs of all the stakeholders. So the two terms or the two statements are coinciding with each other. Am I right? If we say that we have a responsibility towards shareholders only, it's short-termism. Again, if we say that we have to balance the needs of all the stakeholders and we have to meet all of those, it means that we are looking for long-term success. Am I right? How? In short term, if we are not trying to satisfy all the stakeholders, in short term, we are saving costs. We are not spending costs and we are increasing our profit in the short term. But in the future, in the long term, when these stakeholders are not going to be satisfied, our business cannot flourish and shareholders' wealth is not going to be maximized. So all the stakeholders' needs have to be met, whether they are internal, connected, or external. Internal, inside the boundaries of an organization. External, outside the boundaries of an organization. Connected, which are going to be connected through an agreement or any kind of contract to the organization. Now, is it clear to you people that organizations do try to meet the needs of all the stakeholders because ultimately they do want to increase the shareholders' wealth? You can say that the organizations are greedy. Being a financial controller is sometimes being greedy. Why? Because we are trying to meet the needs of all the stakeholders because ultimately we have again a same objective. We want to achieve the objective of increasing shareholders' wealth. That is why we are giving charity, we are giving benefits to our employees, we are doing the good work because ultimately we want the presence of the company in the world and we want to increase the market share. We are fulfilling social responsibility so that the profit can be increased and ultimately shareholders' wealth can be increased. Got it? Now, while satisfying the stakeholders or the needs of the stakeholders, the conflict can arise because the needs and demands of different stakeholders can coincide with each other, can be in conflict to each other. Say, for example, the shareholders do want each and every penny to be saved. But in order to give the benefits to the employees, or in order to say, for example, but we can say over here, the benefits to the company employees, or say, for example, improving the working capital and paying the suppliers in time, say, for example, are both they going to coincide with each other? If we are going to pay the suppliers in time, the working capital in the company is going to be reduced. Am I right? That's why companies do try to delay the payments as well. You know why your salary gets delayed? Because it's the need of the company so that they can manage working capital by holding on the amount of salary of the employees. They use that amount of money in the working capital. So on one hand, the shareholders do want each and every penny to be saved. On the other hand, if we are improving the suppliers' connection, their needs are going to coincide with each other, and both cannot be satisfied in one go. Say, for example, government wants its rules and regulations to be met, to be followed every time, and businesses do have so many unfair advantages to be achieved. Say, for example, so much work is done with the help of bribery. Or say, for example, the tax liabilities are saved with tax evasion. Businesses normally do it. It's unethical, but still it goes on. So again, the needs of the government are going to coincide with the needs of the managers. And ultimately, the shareholders do want their wealth to increase, but still they are not allowed to interfere in the operations of the company. This leads us to the separation of ownership and control. Divorce of ownership and control is there. Shareholders are the parties who own the business. Directors or managers are the ones who are going to control, who are going to manage the operations of the company. Managers of the company will be working for their own benefits. And when they start working for their own benefits, the conflict arises with the shareholders. So when we do try to satisfy the needs of all the stakeholders, what happens? A conflict arises. And this conflict has to be managed. Conflict can arise while meeting the needs and demands of any group of the shareholders. But for most importance is going to be given to the relationship of company managers and shareholders. The major conflict can arise among the management of the company and the shareholders of the company. Why is it so? It is because of the agency problem. And what is an agency problem? We are going to look. Agency theory tells us that when one person works for the other under a contract, one person works on the behalf of the other, an agency relationship comes into being. This is an agency theory. Say, for example, managers work for shareholders of the company. Why do they work in the company? Shareholders do appoint management. These are directors of the company. Why? So that directors can work on the behalf of the shareholders to run the company. In multinational concerns, in public limited company, there are millions of shareholders. All of them cannot come to the company to manage the operations. Is it so? That is why they do appoint some directors from within themselves, or they hire the directors or management from outside so that they can manage the company on behalf of the shareholders. Shareholders are principal, whereas directors are agents. This is one kind of an agency relationship which exists in a company. There can be other kind of agency relationships as well. Say, for example, shareholders and directors both work for employees. Employees work for general customers. So many agency relationships occur in the company. But of most importance is of shareholders and directors. Because a lot of problems arise over here. And why do they arise? Because directors start working for their own particular advantages instead of working for the advantage of shareholders. Instead of trying to increase the shareholders' wealth, they do try to increase their own personal wealth, which is unfair. Got it? Now, in order to align their interests, something has to be done. Otherwise, no financial management can be done. We need to align their interests. Please be clear that all of this thing is ultimately going to move towards financial management. This first chapter is just making your ideas a little bit clear that what are we going to study here. Okay? Today only we are going to learn about some numericals as well. But everything is going to be, has to make a connection with each other. So you should know that principals over here are shareholders and directors are their agents, and the conflict can arise among them in their relation because directors start working for their own personal interest instead of working for the interest of the shareholders. They should work for increasing shareholders' wealth, but they do try to maximize their own wealth. So in order to manage the conflict among them, what we have to do, we have to align their interests. How the alignment of the interests can be done? How the management of the conflict among them can be done? by introducing managerial reward schemes or through corporate governance codes, or there are stock exchange listing requirements in different jurisdictions of the world also. How managerial reward schemes can be implemented to resolve the conflict among shareholders and managers, my dear students? Can you tell? How managerial reward schemes can be used in order to manage the conflict among shareholders and managers?
As well as shareholders growing, share, their ones increasing, so management having like increment in salaries and bonuses, and then there will not be any conflict between them.
Okay, that's great. That's great. Good view. So Arthur said that when the wealth of the shareholders is increasing, the managers can get jealous. And that's why we should have to give something to those managers also. This is how the conflict among the managers and the shareholders can be resolved. My dear students, you must know that directors do get the lucrative salaries from the organization. They are the highest paid in the organization. But still, if they are highly paid, still the conflict can arise. Still they can work for their own personal advantage, because salary is a part of remuneration which is must to be given, even if the performance of the company is good or it is not. We have to align these rewards to profits. If the profits of the company are increasing, then the rewards to the managers or directors will be given. So basic salary should be lesser, but the base salary, like commission, should be higher. In that way, the directors of the company can have an opportunity to resolve the conflicts with the shareholders. But it also has a problem. Even if the bonuses are introduced to them and they are based upon the profits, then the managers will be doing short-termism efforts. Profit is short-term. How? They will be trying to reduce costs for trainings. They will be trying to find the loopholes. They will be moving towards creative accounting, making false accounts, because they do know that their salary is now dependent upon the profit. So it has to be done in a very careful manner. So we know that managerial reward scheme has its advantages, but it is not without disadvantages too. We can have corporate governance codes also in place in order to align the interests of managers and shareholders of the company. How? In UK, we have UK Corporate Governance Code in place. What is corporate governance? The way in which the companies are directed and controlled is corporate governance as per the Cadbury report. Corporate company governance, the way to direct and control. So in UK, a corporate governance code is there, which is principle based. If the companies want to follow it, it's well and good, it's a good practice. If they are not, they have to give the reason that why are they not following. Okay, it is not statutory requirement. Anyhow, if the companies do follow this corporate governance code, it somehow aligns the interests of shareholders and directors of the company. How? UK corporate governance says that our board of directors should be divided among executive directors and non-executive directors. Executive directors will be involved in day-to-day running of the company, whereas non-executive directors will be controlling the activities of executive directors. Got it? The head of executive directors is chief executive officer, one from the executive directors. And the head of overall board is chairman, who is non-executive director. When there is a mix of executive directors and non-executive directors, then shareholders can make sure that there is someone sitting in the company who can oversee the work of the executive directors. Everything is now going to be transparent. There must be one independent non-executive director appointed who can be contacted anytime by the shareholders to communicate about the practices of the executive directors. That what are they doing? What are they up to? Non-executive directors are not financially dependent upon the company. How they are not financially independent? They will be taking the remuneration or money for their services, but they will not be having any shares in the company. Directors, executive directors can have the shares in the company, but non-executive directors are not allowed to have any shares in the company as per UK Corporate Governance Code. Why all of this effort is done? To make sure that now the interests are going to be aligned and managers will not be working for their own interests. Instead, they will be working for the interest of the shareholders. UK corporate governance says that there must be equal number of executive directors and non-executive directors in the company. And when one person, non-executive director, will be chairman, it means that now non-executive directors are more in number than the executive directors. Why this balance is decided? Just to make sure that there is someone overseeing the practices of the executive directors in the company. Got it? So by following corporate governance codes also, we can make sure that the companies now are going to moving towards their objective. The shareholders' wealth ultimately is going to be increased. Non-executive directors do sit in the annual general meetings also. They do not formulate the strategies by themselves, but the strategies which are going to be made by executive directors, by financial controllers or by managers will be overseen by the non-executive directors. They will be present in the remuneration committee as well, which is going to decide the rewards for the executive directors also. There is a mix of directors in remuneration committee as well. In the audit committee also, they will be present to see that sometimes the managers do, make a fraud and try to conceal it in the financial statements. That is why in audit committee also the non-executive directors are present. So in all the organization, non-executive directors are present to make sure that now the interests are going to be aligned. Moreover, after every 3 years, executive directors are going to be changed. Not changed every time, re-election is going to be done. Sometimes the same ones, or they are going to be revolved also. Got it? Okay, then stock exchange listing requirements and other regulations. In particular countries, it varies from jurisdiction to jurisdiction actually. Stock exchange is present in every country, and in every country, some rules and regulations are made for getting a listing in the stock exchange. The companies which are listed in the stock exchange can offer their shares to the general public. Then instead of going straight away to the company, we can just go to the stock exchange to purchase or sell the shares of any company. So in order to get stock exchange listing requirements, in order to get the listing in the stock exchange, there are some requirements regarding this structure which needs to be followed, which ultimately is going to ensure that shareholders' wealth is going to be maximized. I hope you people are clear about it, that we are going to manage the conflict among the different needs and demands of the stakeholders. Can we move on to the next slide?
Yes,
Now, my
Miss.
dear students, from the start, I'm telling you the same thing, that your organizations have to increase the shareholders' wealth because it is an objective of the company. This is a corporate objective. Organizations do try to pursue this objective. How can we measure that whether the corporate objective of increasing shareholders' wealth is met or not? Ratio analysis is one of the popular techniques which is used in order to measure the corporate objectives, measure the achievement of the corporate objectives. Ratio simply tells us the relationship among two items or among two or more items. If something is increasing, on the behalf of which other thing it is increasing? If something is increasing, which other thing is decreasing? In relation to the other thing, when we do try to make make analysis, it is known as ratio analysis. And broadly speaking, 4 broad ratios can be calculated in order to see the achievement of the corporate objectives. And what is that corporate objective? Increase in shareholders' wealth. Profitability and return ratio. Say, for example, you have already read in performance management paper. Which one it is? Gross profit margin, net profit margin, return. Yes, sorry. Yes, please tell. Operating profit margin, very good. Return on capital employed. And this is a form of return also. Then liquidity.
Current ratio.
Excellent. Current ratio, quick ratio, asset test ratio, which we also call it as. Debt and gearing ratio, debt to equity ratio, investors ratio, earning per share, etc. So it's not only to make sure that the corporate objectives are met, we need to measure them as well, my dear students. But when it comes to the not-for-profit organizations, we are not going to discuss them in detail. Ashin, do you want to write it?
No.
We do have a full chapter on this. Right now, it's not a time to discuss all of this.
Fine.
And in financial management exam, sometimes the question on the ratios come, not every time, because it is a subject matter of performance management. In PM and then APM, it is going to be asked anyhow. F7 also, some portion, not a subject matter of F7 again.
Yeah.
Got it?
It came with 20 marks. 20 marks.
Analysis, for analysis.
Yeah,
portion.
came analysis.
Yes. So when we are going to, calculate the ratios and then analyze, it can come. Okay. But no, what about not-for-profit organizations? We do have 2 broad categories of organizations, profit-making and not-for-profit. For profit-making, it's easy because everything is going to be defined in money and money-related terms. We can calculate the achievement of the objectives by putting ratio analysis in place or any other technique in place. But if we do talk about not-for-profit organizations, how are we going to measure the achievement of the objectives? It is difficult to measure the achievement of objectives in the case of not-for-profit organizations. Why is it so? Because the not-for-profit organizations are formed not to earn profit. They do not have a major objective or main objective to increase shareholders' wealth. Their sources of revenue are basically coming from the general public in the form of donations and charities. We never say that not-for-profit organizations does not make surplus. They can make surplus, maybe more than the commercial organizations. But because their basic agenda is not to increase profit, that is why we do call them as not-for-profit organizations. If we have to measure the achievement of objectives in the case of not-for-profit organizations, we will be going for value for money and 3 E's. Maybe you people are aware about value for money audits as well. It's a particular field under audit. Value for money. What is the value which we are generating in against of the money which we are investing? There is value for money. 3E stands for economy, efficiency, and effectiveness. On the basis of these two models, we can measure the achievement of objectives in not-for-profit organizations. In every organization, we have to follow this process. Inputs are going to be sent into the processes and will be converted to the outputs. This is a major process which is followed in each kind of an organization, whether profit-making or not for profit-making. Say, for example, inputs for profit-making mostly can be material, staff, cash. We are going to put them into the process, into the factory. Work is going to be done on them and output is going to be achieved. We are going to see that our operations under the head of economy are fulfilling our requirements. Under the head of efficiency, are they fulfilling? Or under the head of effectiveness, they are fulfilling the objectives or not? What is economy? Can anyone tell me?
Most suitable and least sources.
Sufficient rate of more.
Very good. Very good. I was expecting an answer like cheaper goods or services. Providing cheap goods or services is economy. Having something on the least price is economy. It's wrong.
No, it's efficient. Efficiency is what? Not the cheaper rate, but doing the objective at the time, right?
Very good.
So economy is for like the finance.
No, what which statement I was telling it is wrong. I was telling that I was expecting this answer, but he has given a right answer.
Okay, that's what I was.
No, that was not economy and not even efficiency. Economy is to get the outputs with the suitable levels of inputs. This is economy. Getting the best outputs with the help of the suitable or adequate inputs. This is economy. It is not to get cheaper resources to get, less quality outputs. It is going to be wrong then. Economy is getting the outputs, the good outputs with the help of the most suitable inputs. This is economy. If it is being done in the not-for-profit organizations, we can say that they are achieving the efficiency and effectiveness. These are the terms where students do get confused. Harshit was telling me the definition for efficiency and it was absolutely correct. What is that, Harshit?
Like doing the work in an efficient manner so that like optimal utilization of resources.
And our objectives should be met.
Yeah, exactly.
Not more than that. Efficiency is up to the level of objectives. Whatever our requirement is, we are meeting it. Effectiveness is going beyond that. I would like to give you an example for efficiency and effectiveness. Okay. Say, for example, there are two groups of laborers, and group A and group B. We are telling both of them to make balls. Group A is going to make a ball on the left side and group B on the right side. Group A, and we are giving them the time of up to 1 hour, say for example. After 1 hour, group A finishes the ball and group B also finishes the ball. But when we see the work of group A, it was having some sort of mistakes in it, having more cement at some places, or the bricks are not adjusted in a good manner. This is efficiency. In time, they have met an objective of making a wall because the objective was to make a wall in 1 hour. Group B has also made a wall, but when we analyze their work, it is up to the quality. More than objective they have done. They have fulfilled an objective, but the qualitative aspects are also met. So this is a slight difference in between efficiency and effectiveness. Whatever is required, we are doing, but when we are adding up something in it and the outcomes are very nice, then it is effectiveness. So when something is going to be done in this manner, economy, efficiency, and effectiveness is going to be met, we can say that the objectives of NFP are going to be met. In case of NFP, what are the inputs? Inputs are donations or charities. And outputs are the betterment of the general public. So we have to see that whether this economy objective is met. Efficiency is going to be the objective, the minimum level of the standard with the help of those donations and charity is going to be met. Effectiveness, the people are also becoming happy. We are bringing health to the general public. We are bringing happiness to them. It's effectiveness. Got it?
Yes.
Now here is the time for understanding. Quickly, I would like to do it. This is just a revision of the concept. So say to see that whether you are clear or not. Which of the following is not, sometimes in the exam, you may be already aware that sometime in the exam it is going to be asked. Which of the following is not one of the three main types of the decisions facing the financial manager in a organization? Very good. The three basic areas which we have to study are dividend, investment, and financing. This is not under the area of financial management, economic decisions. So you're very right, Harsha. Excellent. Are you clear, Atif? And what about you, Angelica?
Yes, Miss, it's clear.
Okay. Okay, now the next one, the agency problem. What is an agency problem? When there is a conflict of interest among shareholders and managers. Yes, very good. The agency problem is a driving force behind the growing importance attached to the sound corporate governance. The statement is correct. In this context, the agents are the customers, shareholders, managers, or the auditors.
Shareholders.
Managers, very good. They can also, all of these can be the agents to the other parties. But in the context in which the statement is being written for corporate governance, here the agents are managers of the shareholders. Got it? Cleared? The next one. Which of the following is an example of the financial objective? Financial objective, not a commercial one, that a company might choose to pursue. Provision of good wages and salaries.
Yes.
Okay. Dealing honestly. Okay, dealing honestly and fairly with customers on all occasions. Producing environmentally friendly products. Restricting the level of gearing to below a specified target level.
Okay.
Okay, Harshil, what about you?
I'll go for A.
A is going to be a financial objective.
No, sorry.
It's not provision of wages and salaries. It is provision of good wages and salaries.
Oh, okay. It's a deal. I didn't have.
Restricting the level of gearing to below a specified target level. This one is a financial objective.
One was.
The other ones are more or less related to the social responsibilities. Got it? Angelica, are you clear?
So professional
Yes,
operations are financial operations, right?
Financial objective, operational level. Okay, now this one. In the context of managing performance in not-for-profit organizations, which of the following definitions is incorrect? A, value for money means providing a service in a way which is economical, efficient, and effective. Is this correct? You have to choose one which is incorrect in context of not-for-profit organizations. Value for money means
It's correct.
providing a service in a way which is economical, efficient, and effective. What were the three E's which we have discussed? Economy, efficiency, effectiveness. So this one is true.
That's true.
Economy means doing things cheaply. Is that so? Not spending $2 when same thing can be brought for $1.
True. It's true.
Economy means doing things cheaply. Minimizing the amount of time that is spent on a given activity.
False.
What do you think, Atif?
Yes.
It's correct. Efficiency means doing things quickly, minimizing the amount of time that is spent on a given activity. Minimizing. When I gave you an example of two groups of laborers,
Yeah, so
what happened?
Within the given time.
Minimizing the amount of time. So is this correct? Is efficiency related to minimizing the amount of time? So then how is it correct? Effectiveness means doing the right things, spending funds so as to achieve the organization's objectives. It's correct. So which one is incorrect? C.
C.
Very good. So these three are correct. C is in. Are you clear now? So this one was the only point making it incorrect. Within a time, whatever objective is given, we are doing. Okay, now, here is from where the technical discussion starts. This is the chapter 2 of our book. And this is the first portion, investment decisions. Investment decision is now started. Further 4 chapters are on this, investment decisions. Then we have few chapters for financing decisions and few chapters for dividend decisions. And this one is my favorite topic as well. And I hope you people are also going to enjoy it very much. And one question is must from this portion. Got it? Basic investment appraisal techniques. Financial managers have one duty to make the investment decisions, to deploy the funds in suitable investment opportunities. They are not going to invest the finance blindly. They have to raise the finance from suitable source. That is a separate debate. They have raised the finance from the source, suitable source. Now they have to deploy it. This is a second stage, and that is about investment appraisal techniques. Different investment opportunities are under place. Say, for example, I was giving an example before as well. Different opportunities are in place. Which investment opportunity has to be selected? It's future. It's in future. But we have to decide right now so that we can deploy the funds, we can implement the funds in a suitable manner. On the basis of expected future cash flows and the cost which we are going to spend, we are going to appraise the investment opportunities. How much cost, estimated cost we are going to spend on the project, and what are the expected future cash flows. The time value of money is also going to be involved in this case at an advanced level. Whenever we are talking about the future, time value of money is going to be there. The value of $1 today is not going to be the same as it is going to be in the future. Got it? So the investment opportunities are going to be appraised on the basis of expected future cash flows, inflows and outflows both, and estimated cost which we are going to spend on any project. So this is chapter number 2 of your book, Basic Investment Appraisal Techniques. In this chapter, we are going to learn the basics. In chapter 2, next stage. In chapter 3, then the next one. This is an overview of this chapter. In this chapter, only this is going to be covered. Investment appraisal techniques, we will be learning about accounting profits and cash flows, which I have already tried to build a knowledge about. Cash flows are not the same as the accounting profits. Accounting profits are based upon accruals. Cash flows are different. These are actual cash flows, liquidity of the organization. We are going to discuss about the cash flows and the relevant costs. Whenever the organization has to appraise any investment opportunity, it will be based upon the relevant costs. What are the relevant estimated costs which are going to be under consideration in order to appraise an investment? Angelica, are you cleared? We are
Yes,
going to discuss about this as well. And we are then going to discuss about the basic performance investment appraisal techniques. Basic ones are return on capital employed and payback period. Can anyone tell me the formula for return on capital employed?
Profit before interest and tax divided capital.
Very good, very nice, because this is what we have already done in our previous studies as well. Over here, we are going to have a little bit deeper view out of it. Not that much deeper, but with the help of initial capital costs or average capital employed, we are going to learn it. We are going to discuss about the advantages and disadvantages of both the techniques. So this is an overview of chapter, very small chapter. We are going to do this. So without any delay, we will be moving on to the first slide of this. That is about return on capital employed. Simple formula is given. You should also know that it is also known as accounting rate of return, ARR. Why do we call it as accounting rate of return? Students, the detail that I do tell you, this should have to be absorbed by you so that you can use it in exam. In exam, you have to analyze the situation and you have to comment according to this discussion. Now, they have told you that it is an accounting rate of return, but you have to make a connection out of it. Then why do we call it as accounting rate of return? Because it is related to the accounting profits. It is not, this technique is not based upon cash flows. This is based upon accounting profits, and that is its basic disadvantage. Whenever something is based upon profit, it means that it is having some kind of subjectivity in it. Because accounting profits every time have subjectivity in it. Like IS 37, F7 you have done. F7 is completed for you. IS 37 provisions, contingencies, contingent assets and contingent liabilities. It is a subjective thing. The creative accounting is being done so the provision can be increased and the profit can be decreased and minimum dividend can be given to the shareholder. So whenever accounting profit is under consideration, it has its drawbacks. Got it? So this is one of the disadvantages of ROCE. Anyhow, the simple formula of ROCE is average annual profits before interest and tax. This is also known as PBIT, profit before interest and tax. We do call it as operating profit also. Got it? Average annual profits before interest and tax. Or if average annual profits are not given to you, you can use simply annual profits before interest and tax. If they have given you net profit, you have to add back interest and tax in it to get profit before interest and tax. Divided by initial capital costs. Capital employed is an amount of capital invested. So basically, capital costs are the same. It is a capital employed. Either you will be required to use initial costs or you will be required to use average capital employed. If in exam they are not mentioning anything, go for initial capital costs. If they are going to say, tell you and giving the information, then use average capital employed. And it is initial investment plus scrap value divided by 2. What is a scrap value? When we do talk about investment, basically it's about a long-term investment in a non-current asset. And scrap value is a value of an asset at which that asset can be sold at the end of its useful life. So average capital investment will be initial investment plus scrap value divided by 2. And what will be the decision rule under return on capital employed? Because it is an investment appraisal technique. Whether to go with an investment or not, we are appraising that investment. Shall we pursue that investment opportunity or not? If its return on capital employed is, say, for example, 5%, 10%, which one we have to pursue?
10%.
10%? If I say that the target which has been set by the management was 50%, then both are not good. So we are going to compare the return of capital employed with the target rate which the management has set. Got it? So we are going to look for the another opportunity then. So the decision rule is that if return on capital employed is equal or greater than the target set by the management. So again, in this technique, subjectivity is involved. On one side, subjectivity is in, when we are using accounting profits. On the other hand, subjectivity is in the target level set by the management. It is their own decision, whichever target they can set, they will be setting it. Got it? Are you clear up to here, everyone?
Yes, Miss.
Okay, great. I hope I'm not going so much quick. Is it fine for you? Fine? Slow? Sorry? Very fast. Okay. Investment appraisal now, return on capital employed, we have a question in place. Whenever in the exam the question is given to you, please read the requirement first. Okay? Determine the project's return on capital employed using initial capital costs, average capital investment. Got it, Hashim? So both of the ways you can use in order to calculate the return on capital employed. If we are using initial capital investments, which formula do we use? Average profit before interest and tax divided by initial capital cost multiplied by 100. If we are using average capital investment, average profit before interest and tax divided by initial capital cost plus scrap value divided by 2 multiplied by 100. Am I right?
Yes.
Now the question is, a project involves the immediate purchase of an item of plant costing 110,000. What is it? Initial capital cost. Am I right?
Yes.
A project involves the immediate purchase of an item of plant costing 110,000. This is initial capital cost. So can we put it over here simply? How much it is?
110,000.
110,000. Over here also we will be using it. So we can just put it over here also, wherever it is required. Getting my point?
Yeah.
It would generate, Angelica, are you able to see it?
Yeah, Miss, I am.
Okay, that's good. That's good. It's actually good to know. It would generate annual cash flows of 24,400. What is it, students? This is the cash flow. You need to distinguish between cash flow and profit. This is cash flow, not a profit. So we have to make some adjustment in it so to make it a profit. Got it? For 5 years, starting in year 1, the plant purchased would have a scrap value of 10,000 in 5 years. The scrap value is there.
Yes.
We can put it over here. How much it is? 10,000. Okay, now average profit before interest and tax. Because we are making a capital investment investing in an asset, there would be a depreciation. And when we are going to make an adjustment regarding depreciation, the cash flow will be converted to the profit before interest and tax. Getting it? So how much depreciation will be there?
Divided by 5.
Yes, that is the working life of an asset. How do we calculate depreciation, students? The cost of an asset plus scrap value divided by useful life of an asset. This is the formula. So what is the cost of an asset? 110,000. What is the scrap value? 10,000. What is the useful life? What
5
is the
years.
depreciation?
24.
What is it?
24,000.
Oh, sorry. Minus. We always minus scrap value. 110,000 minus 10,000. The formula for calculating depreciation is cost minus scrap value divided by working useful life of an asset. So 110,000 minus 10,000 divided by 5. So how much it is?
20,000.
20,000. Is it clear up to here?
Yes.
So how much average profit before interest and tax will be there? 24,400 minus
Difference.
20,000. How much it is?
4,400.
4,400. Where else we can use it? Over here as well. Is it? Now please calculate the answers. For this first case, 4,400 divided by 110,000.
4%.
4%.
Yes.
What about the second one?
No, 7.
7.3.
Got it? Are you clear?
Yes.
Have a look at it. Do you want to write it or should we move on?
No.
Jan, Atif, are you cleared? Okay, now we have one more question. Please have a look at this question. Read it by yourself. First, read the requirement first. Determine the project's return on capital employed using initial capital cost, average capital investment. So students, again, the same formulas are going to be used. Let's read a scenario now. A project requires an initial investment of 800,000. So our first figure is now sought out. And then earns net cash inflows as follows. There are different cash flows given in front of us. Year 1 to 7, and cash flows are given for all these 7 years respectively. What we are going to do in this case, we will be taking average. Now, got it? That is what I told you. If they have given you an information in which you can apply an average, then you have to. So you are now then going to convert the cash flows into the average cash inflows. In addition, at the end of the 7-year project, the assets initially purchased will be sold for 100,000. The scrap value is also given. Can you do this question? Yes. Please try to do it by yourself. Can you try to do it? It's very simple. You need to take the depreciation. You are going to calculate the profit. You have to take the average of the cash inflows. And then with initial capital cost and with average capital investment, you have to do this question.
100,000, right, per year?
How much?
100,000 because, no.
800,000
Minus
minus 100. Yes, you are right. It's 100,000. Look, 800,000 is the initial one.
Minus the 100,000.
Scrap value is 100,000.
Divided by 7.
Working life is 7 years. So it is how much? 100,000. Got it? Okay, now average cash flows, how much it is? 100 plus 200, 300, 700, 1100, 250,000 total or average?
Average.
Average? Okay. So average capital cash flows are 250,000. Okay, then yes, 100,000 depreciation is going to be, and then we have next working is average capital investment. Please just put them in the formula. Average capital investment initial is 800,000. Then we have 100,000 divided by 2. How much? 900 minus divided by 2? 450,000. Please put all of these in the formula. Average capital employed will be 250,000 minus, what is depreciation? 100,000. So 150,000 will be average profit before interest and tax. Done? Is it easy?
Yes, miss.
Are you clear? Angelica, have you solved both of these?
Yeah, miss.
So whenever you are going to be given the cash flows in this way, you have to take an average simply. You are going to deduct depreciation, you will be getting a profit. So average profit will be 150,000. 250,000 minus 100,000. Initial capital investment is 800,000 and average capital investment is initial plus scrap value divided by 2. That is 450,000. If you still have any confusion, please do ask.
Can you write the answers by the rules?
Sorry?
Can you write the answers? Why these number of us confused with formula?
Sorry?
Can we write the answers for 4 of us?
What do you want?
Answers, percentage answers of 4 of us. What is the answer?
You want the answer?
Do you want the answers?
Yes. When
Over here to be calculated?
if you match to each other,
Oh, yes, sure.
at least you will come.
Okay, yes.
Maybe
Yes, maybe. Yes. So what is your answer for part A, Angelica?
18.75%.
18.75? Ashir, what about you? Ashir didn't calculate.
For B, it's 33.3%.
Second one is 23.
Okay, second one is 33.33. Very good. So what is going to be the decision rule if it is equal or greater than the target return on capital employed? Then it is going to be accepted. Otherwise, no. Ashir, are you getting the same answer?
Yeah.
I think that I do not need to calculate the answers. Is it fine? Do you got the same answer, 33.33? Okay. Shall we move on? Ashir, are your answers the same? Okay, now. Return on capital employed, advantages and disadvantages. Advantage is simplicity. Whichever model you understand, you can give an advantage of it as it is simple to understand. Because simple calculations, simple formulas are used in it, and it is easy to be understood. Links with other accounting measures. Say, for example, if you are using any kind of other accounting measure, profitability margin, operating profit margin, or net profit margin, it is interrelated to that. What are the disadvantages? No account is taken of the project's life. We are not taking into account project life every time because it is not the requirement of the formula. Where it is given in the scenario, we are using it, but when it is not, no requirement as such, but it is necessary when we are dealing with the practical situations. No account is taken of the timing of the cash flows because time value of the money is very important. Say, for example, the cash flow are given straight away in front of us without considering their time value. 300 which we are earning in year 7 is not going to be having the same value right now, but we have to take the decisions right now. So we have to take into account the time value of money. But this rule, this model is not taking into view the time value of money. It varies depending upon the accounting policies. Whichever depreciation policy is going on, it is going to be dependent upon that. And it will be varied upon that. It may ignore working capital requirements. It is taking into consideration the capital costs, the investments into the capital assets, but not into the working capital. What about the day-to-day decisions then? It is also the part of accounting. It does not measure absolute gain. It is about the relative gain. The complete picture is not shown in front of us. We are dependent upon profits, not the cash flows. So absolute means complete. Complete picture is not in front of us. There is no definitive investment signal. We do not have any investment signal. Whether we have to choose certain investment project or not, we do not have any signal. When we will be moving towards the other popular investment appraisal techniques, you will be coming to know that how they will be taking account of all these things. Got it? But it is not an absolute one. So students, we are not going to move forward for today. We have other things to be considered, but I think we would not be able to finish. Okay? So anyhow, we have finished our chapter number 2 almost. My dear students, I do not want to go very quick. I have just made a planner for all of the topics. And together with the book, with all the understandings in the book, if you can see in my taxation paper as well, in this one, I do try to cover all the understandings which are present in the book. And together with that, in the class, we have a plan to cover the exam kit as well. So every lecture, we will try to finish around 1.5 or 2 chapters. So in that way, we will be covering our syllabus in a very nice way with elaborated concepts. So now when you are going to open the books in your homes, you will not find any concept which is newer, which is not being taught in the class. And this is my basic objective. And Kaplan is very detailed book. We are not going for VPP because VPP does have little bit summarized concepts. Okay, they do use jargons, but they are not given the details for that. Kaplan explains everything. So I am going according to the Kaplan, and I will be going with this speed. Okay, fine for you. If you do have any problem, you can ask me. Angelica, if you do have any problem, you can ask me.
So far, Miss, I don't have any questions right now.
Okay, that's true. So now what you have to do, you will be having 1 full week. You have to revise all these concepts from your study text. I will be sharing it with you people. Apart from that, you have to open the exam kits as well and try to solve the relevant concepts. After finishing every 4 chapters, we will be moving to the exam kit. After every 4 chapters, exam kit, we will be doing the questions from. And wherever you will be feeling confusion, you have to ask me because obviously we will not be having the time to solve each and every question from exam. We will be doing the selective questions. And if you are going to do the questions from your home, wherever you have felt problem, you then are going to ask me. Okay? This is how we will be going. in both these questions, what was the basic difference? It was only that in one question,
It was not average.
yes, in one question we did not go for average. In the other one, we have taken an average. And the next slides are also, these are also very easy. But if I had started them, these are detailed. We would not be able to finish them all. Okay? Yes, now Atif, when you were not in the classroom, we have discussed the paper pattern. Okay? Your paper will be divided into 3 portions. Okay, like the other papers, FM, the PM also you have given, F7 also. This paper is also going to be divided into 3 portions. First portion, short questions containing multiple choice questions, true false statements, drag down list, drop down, it is going to be there. Okay, 15 short questions carrying 2 marks each. So this portion will be for 30 marks. The second portion will be containing 3 objective type cases. A scenario will be given to you, and from that scenario, you have to solve the given questions. 3 OT cases, objective type cases will be given to you, each carrying 10 marks. So total marks for this portion will be 30. And the last portion is going to have the comprehensive response questions. 2 comprehensive response questions will be given to you, for which you have to give a detailed answer. Okay? Each of comprehensive response question will be carrying 20 marks each. So the total of it would be 40 marks. Got it? And we had just started the chapter number 1 when you came. We had just discussed the definition of financial management, which I hope that you are now clear about. If you can read this definition also, financial management is concerned with the efficient acquisition. Efficient acquisition to select the good source of finance, appropriate source of finance, and deployment of both short and long-term financial resources. Now, after selecting the suitable source of finance and acquiring it, then the second duty is to deploy it, is to invest it into both long-term and short-term financial resources. Financial resources, assets. To ensure the objectives of the enterprise are achieved. What is an objective? To increase shareholders. So this is the subject matter of financial management. And the 3 portions. From this slide you were with us. Is it? Investment, finance, and dividends. So we have started the portion of investment. We are then going to start the portion of finance and then in the end dividends. So I hope that you are clear about each and everything. Now I would like to take a leave. If you do have any questions, you can ask. Yes, I will be sending you the soft copy of that on the registered email ID and through WhatsApp group as well. Can we please make a WhatsApp group right now? Angelica, can you please write your WhatsApp number so that we can add you in the tax group and the financial management? Do you have her number? Because in the tax group she is not added.
I'll just write my name, my number, miss, and just in case.
Okay, okay, that's good. I think we have 1 more student or 2 more students in this class. If they have not joined the student. Okay, Angelica, thank you so much. I have received your number.
Thank you, miss.
You're welcome, dear. Okay, so this is the end of the class. See you next time.
Bye,
Take
miss.
care
See
of
you.
yourself. See you. Bye.